just having a tight action like this, if we were to
Mm-hmm.
close right here, I would say that's starting to be constructive, but it's certainly not anything, it's not giving you a reason to add more into the market. So let's
Yeah.
say, I think there were some questions about what nibble means. So let's, nibble is different for everybody. So let's start at what is your normal size position in a good market. So let's say it's 15%. That's your starting position. And that's, for a concentrated portfolio, that's what a lot of people do. So in a position where you're waiting for a follow through, you'd probably take that in half, just like what we're doing with leaderboard and swing trader. Then, so now you're dealing with, let's just call it a 7.5 percent, or that's what it is. And then you want to move down from there quite a bit because of we just had a crash. So let's bring that down to, let's say, 3% as your starting position. But on top of that, now we're just early in, and it's our first follow through. So take that in half again, a 1.5%. Now we just have this, pathetic follow through, like the most pathetic one that I can remember. So then you cut that in half again. So maybe your starting position is 0.5% or 1%. And you might ask, well, what does that do? I mean, it's so small. It's just training you to kind of adjust your position size to what the market is telling you. Now, the worst case scenario is we just rip up from here, and then you're going to have to increase your position, the size on that stock, and be a little lopsided. But the best case is if we, fail next week or today, then you didn't get hurt that much. And so it's really about protecting your psychology, and that goes along with protecting your wallet. So I think the risk reward right now is keep it as small as possible, but you still want to play by the book.